You're listening to the Travis Makes Money podcast presented by GoHighLevel.com. For a free 30-day trial of the best all-in-one digital marketing software tool on the planet, just go to GoHighLevel.com/Travis. Hey, what's going on, money makers? Welcome back to the Travis Makes Money podcast, where it's our mission to help you make more money. Today on the show, we're talking a little bit about real estate with my new friend, Lane Kawaoka. Lane owns over 10,000 rental units now and leads the Who Ideal Pipeline Club, which has acquired over $2.1 billion of real estate by syndicating $200 million in private equity since 2016. And he's returned over $45 million to his investors in distributions alone. Lane uses his engineering degree to reverse engineer wealth building strategies the rich use in his top 50 investing podcast, The Wealth Elevator. Before we jump into this conversation with Lane, if you're curious how I go about building relationships with the amazing people on this show or on my other show, Travis Makes Friends, like Shaq and Dane Cook and Rob Deerdeck and all those guys, it's been through the podcast. The podcast is the number one way, in my opinion, to explode your network. So if you are a 7, 8, or 9-figure business owner and looking to do anything like that this year, head over to travischappell.com/coaching. See if we might be a good fit to get your podcast out into the world. Now, without further ado, Lane, what's up, dude? Welcome to the show.
Hey, thanks for having me. Aloha, everybody.
So let's start off with a softball question here, Lane. How do you currently make money?
So we put together real estate syndications, and we also we look for deals out there by entrepreneurs who want to sell their business or want to joint venture on future expansions. And we have a base of investors that want to invest. So we've brought over $230 million to the table in the past from our investor base. And when you do that, you make money.
Yeah, you tend to.
Yeah,
Although there's plenty of people, though, that have raised $230 million for things that don't make money. So congrats to you for being able to do both of those things. Talk to me about before that, though. What were you doing back? Like, is this kind of day job engineer trying to learn real estate on the side type of a thing? Or how exactly did you get started?
Yeah, I mean, it's been a long time coming. I mean, 2007, I graduated from college with an engineering degree. Up until that point, I call it the linear path. You know, we're all taught to will study hard and invest in the 401k and all the traditional investments. And then, you know, I bought a house to live in, still brainwashed, right, to buy a house to live in and everything. And on a whim, I just started to rent it out. And that was kind of where I got the taste of cash flow and alternative investments and just started to rinse, wash, repeat.
Wait, so on a whim, you decided to rent it out. Were you like moving somewhere, or were you just like, I wonder what I could get for this?
Yeah, I mean, I was a construction supervisor at the time, so I was never home, right? Because you know, you travel out to all the projects,
Gotcha.
and I was in my early 20s at the time, bachelor, and I could kind of do what I wanted. And I was only home on Saturday, so I was like, this is kind of silly to have this big
Yeah.
house to myself in Seattle. And I was like, well, why don't you just rent this stuff out? And lo and behold, I just started to do that. And you know, it's funny you're in Vegas, like. I can remember sometimes I wouldn't go back home to Seattle. I would, you know, instead of going home, I'd go to Vegas for the weekend, right? Because I didn't
Yeah.
have a place to live in. But, you know, before I did that, I made a decent salary as an engineer, right? And that's the big part of this. To invest in real estate, you need to have a decent salary or income or somewhat of a successful business. Like, I don't teach people how to wholesale houses and flip houses. To me, that's what you do when you're broke.
Hmm.
You know,
It's
what
active
we do,
income, not
active income.
yeah.
Right. So like I was able to save maybe 30, 40 grand per year. But then when I started to rent my own house out and sort of be homeless, I was able to put away like almost 100 grand every year for 4 or 5 years. And just
Wow.
by that was 2009, 2015, I had 11 of these turnkey rentals, which I think is a great way to get started. You know, like for non-accredited investors out there who haven't hit the $1 million net worth yet. I mean, that's what I did. I bought a house sight unseen in a lot of these more secondary and tertiary markets where the rent to value ratios are 1% or higher. You know, we wouldn't buy things, you know, like what the rent to value ratio is you take the monthly rent price divided by the purchase price.
Yeah.
You know, if nothing works in California, Hawaii, it ain't gonna work, guys. Not gonna
Yeah.
work. You know, you're buying properties out there for like 400 grand that rent for $2,000 a month. That's 0.5%. No
Right.
bueno. That's not gonna work. So I would just kind of keep rinse, wash, repeat until 2015 happened. And then I started to interact with all these accredited investor cats, and that was kind of the big aha moment. Like before this, I was just doing this all by myself,
And
and
for personal reasons, just to like, hey, I'm making money, I'm making good money, may as well start parking it somewhere. And then you were buying turnkey, so you were actually finding companies that were doing all the work for you, essentially. Like you were not selling turnkey, you were just looking for turnkey properties that already existed. They were already rehabbed, they were already rented, they already had a cash flow person in there, they already had a property manager running the property for you. You literally just basically switch the title and start getting the rent checks, essentially.
pretty much, yeah. I mean, that's a great way for people to get started,
Yeah.
right? And some people are like, well, you can go and find deals out there, but it's like I had better stuff to do at my
Mm.
day job, right? Than to dick around and the burst strategy is what a lot of people talk about, but it's so risky doing
Mm.
that stuff, especially when you're doing it remotely. Perhaps I could have progressed a lot faster and got to 11 rentals faster, but I think from 2009 to 2015, that was a pretty decent pace, right? But
Yeah.
then from there, started to invest in syndications and private placements because as an accredited investor, you are a much higher target to be sued. So it's better to be in an LP position.
Mm.
The tax benefits are stronger in syndications because you can do a cost segregation on a bigger asset. And it's a pain in the ass to do those single family homes. That's what you do when you're not a credit investor, essentially.
Yeah. Yeah. So you eventually got to the point where you earned accreditation status, and then decided I want to be in on bigger deals, and ultimately went full time with it. Right.
Yeah, yeah. So, and did what I think a lot of people will do is they'll join these BS guru groups that teach you how to do these deals. I did learn how to underwrite deals, so that was cool. But I think the success rate of people who join those types of groups is like 2%, right? You
Yeah.
pay 50 grand for this mentorship and nobody goes anywhere.
It's very, very
But
low. Yeah.
yeah, yeah.
Although
But
they'll, although
it's
they'll bring those people up on stage and show you.
oh yeah, yeah,
Yeah.
that's the dog and pony show, right? Like,
Yeah.
they'll show you to all the other unsuccessful students
Yeah.
in a way.
Yeah.
But yeah, I started to do that. And then then I was like, well, I'll just be a passive investor, right? I was a passive investor from the start. My, I started to work for easier jobs, I moved from private, which is usually lower quality of life, better pay. And then I moved more towards government jobs, right?
Mm.
Although who knows now, right? Maybe it's not so great to work for
Yeah.
the government.
Fair. Yeah. Fair.
I was telling my wife the other day, like if I got that email from Elon, I don't know what the hell I would write down. I mean, I'd probably use GPT to make something up,
Yeah.
right?
Exactly. Throw it in grok real quick. Yeah.
Yeah, yeah. But I mean, by the end there, I wasn't doing too much at my day job. And that was kind of how I transitioned out because I guess I missed this part of the story. Like I started to invest passively in deals, but like when you're investing with operators who've done less than $500 million of deals, or even $1 billion or less, they're kind of newbies
Yeah.
and it's all over the place.
Thank you so much for saying that. Can you park here for a second and talk about why that is? Because it sound for an untrained ear, that sounds insane. What you're saying, it sounds insane to be like, oh, they only have a quarter billion in real estate or something like that. But you have to understand when you're buying deals that are 40 million a piece, you're still pretty green in the process when you only have a quarter billion in assets under management. So can you kind of expound on that for a second and why it's important to look into like who these operators are and how much experience they have?
Yeah, I mean it's super confusing to be honest. And there's all these BS games people like to play. Like, I mean, like I said, when I was first started, I was an LP in a handful of deals, right?
Yeah.
And each of
Limited
those
partner.
deals, yeah, limited partner. And maybe they were like $50 million deals each. Although I only had like 50 grand in each deal, I could have technically said I owned because I'm a
Yeah.
passive investor in
AUM
200.
baby. Yeah.
Yeah. So, but most people know that that's total BS, right? Like, I mean, if you're a GP in these deals, then you should be, but you could just also be a small part of the general partnership.
Right.
Like this thus far, I've been $2 billion of deals as the main sponsor and
Mm.
capital group of the deal. I mean, if you want to include my LP stuff, maybe who knows? It's maybe like 3 or 4 billion
Mhm.
I mean, it doesn't matter, right? It doesn't matter if you're LP in the deal. That doesn't tell you jack, or you don't learn anything from that experience.
Right. Right.
But also, like, how do you know I'm not just making this stuff up, right? It's like,
Right.
and that was where, like, when I was a passive, it's like it was important for me to know the players that knew the players, and to vet like the lawyers, the the peers,
Yeah.
general partner peers, to kind of know. And that's what we kind of use today to help do our due diligence, and digging up dirt on potential partners we work with these days.
Were you
As being
also like,
insiders in the industry.
were you also trying to underwrite these deals before you put money in them? Like, were you doing that
Yeah,
personally?
yeah. So I mean, that's, I think, what most good investors will do. But when you're a passive investor, you never get the P&Ls and the rent rolls. So I don't know what the hell people are looking at.
Right. Right.
Um, and plus a lot of the data is through like systems like CoStar or Yardi, where these subscription services, it costs like 5 figures, right? So like your average LP investor will not have access to that database. It's good
Right.
data, but that's what creates a gap, right? And as an entrepreneur, I sort of saw that, like, here I was, my first couple years investing as an LP. It's just like, who the hell do you tell apart from all these fake it till you make it people, where all they teach you in these guru groups is how to parade yourself on social media, and how to make a website for yourself, and how to be a podcast guest. And then, they don't tell about anything about operating deals, or very
Right.
little bit about underwriting the deals. And you really have to be an insider in the ecosystem. It's not a big ecosystem, is the thing. But,
Yeah.
that was the need, I think, like, because it was like myself who, like, the first 15 deals I went to as a passive slash general partner in some of these, like I would say like 1/5 of the time it was just with a shyster, or somebody
Mhm.
was just faking it till they make it.
Yeah. Yeah. So did you lose a good amount of money at first?
Oh yeah. Yeah, for sure. I
Yeah.
mean, multiple 5 figures doing
Yeah.
this, yeah, in the beginning stages. But
But now,
like, I think as a passive investor, you don't have a network either, right? Like, that's part of the
right.
game.
Right. Yeah, exactly. And I wanted to ask that because people tend to romanticize everything that they hear and see online, and especially as it relates to growing wealth. And they get sucked into these deals and opportunities. And then when it goes, if and when it goes south, they tend to just throw stones at the operator, and then um, just immediately jump to calling them a scam artist or something like that. And it's like, well, it's a little bit more nuanced than that, right? Like some people are, for sure. And we've actually seen several federal indictments coming down around the commercial real estate industry recently, specifically in syndicating, at least for people that I was familiar with. But there's also just sometimes like the deal goes south, or the bank doesn't extend leverage like they said they were going to, especially in a rising interest rate environment like we've seen in the last 2 to 3 years, and a consolidation of commercial real estate, which we've also seen in the last few years. So what are like, how do we know as a passive investor what we're getting ourselves into? Like, if we can't vet the deal, if we can't underwrite, if we can't see the numbers, if we think this person's a good person, but we don't really actually know them, with the rising interest rate environment, like how do we think about deploying this capital while also trying to de-risk the investment as much as we can?
Yeah, I mean, multi-step thing here, right? The first thing is just getting educated, right? Understanding the lingo, understanding what are the assumptions I need to look at in the pretty PDF to spot check. What is the reversion cap rate they're using? What is the full occupancy they're assuming? What are they assuming that the rents are going to go up every year, right? To kind of check, are we being somewhat conservative here? Or are we smoking ganja thinking that this is going to happen in the future? And then that drives amazing projected returns,
Yeah,
right? Like, the operator can put whatever projected returns they want,
literally.
as long as they say what their assumptions are, or kind of put it out there. I mean, I
Right.
don't know if that's true. Maybe they don't even have to put that out there, right? Like,
Yeah, yeah. That's the big thing, is just challenging the assumptions, or at least
yeah,
interrogating the projections, because like you said, you could literally just, it's just coding it into the Google sheet. They didn't have to pass any sort of inspection or third party accounting audit to be able to put that projection in the sheet. They can just put whatever they want there. And that's not to say that they're intentionally misleading you if they don't hit those numbers, but that is to say that that's not guaranteed money.
Yeah, and that's the first step, right? As an LP, to intelligently be able to understand what those cells in the spreadsheet are that really drives the numbers artificially up or down. So like I think after that, right? Like most times it takes investors maybe 3 to 6 months to get over that hump. Like we have a free syndication LPE course for people to kind of get over that. I'd say at that point, then it's like more about like vetting the people. But still, like you said, like people are really good at hiding things on the internet. And
Yeah.
until like people, as I've always said, until bullets fly and people start to go through trouble, and this is me speaking with my fellow GPs on that level, you don't know people's true colors,
Yeah.
right? I think
Yeah.
the best other way, other than just getting to bed with each other and seeing how it goes when problems start to happen, and is to know other people that know other people, right? So that's
Yeah.
sort of this proxy idea. And that's kind of why, like, for our investors, we're big on community, right? We don't let everybody in. If you're not a nice dude, like, we don't want you to hang out with you,
Yeah.
right? But like, it's just this kind of to create this ecosystem of other passive investors looking out for one another, and then also, kind of looking over each other's shoulders and what they're doing. I think when you combine that with, the analytical side of looking at deals objectively with like their numbers, I think you can make headway in this business, especially like a lot of our investors are first generation multimillionaires. When you're talking second, third generation money, they already know who they're working with.
Sure.
It's already
Sure.
family friends at that point.
Right.
But this is the hardest part, is the first generation multimillionaire. And that's kind of the blueprint that I kind of broke down in my book, The Wealth Elevator, right? Because this is the hardest part, make no
Yeah.
mistake. And you don't want to lose money because it's going to hurt a lot. And you're going to go back to square one if you lose your money, right?
Yeah. Yeah. I'm curious to hear your answer to this, Lane. I've asked a lot of people this question, hundreds now at this point, and I think it's a perfect time to ask it because we're just talking a little bit about both of these things. Do you believe that who you know or what you know is more important as an asset in life, and why?
I think I think it's based on like paradigms, like where you're at. When you're broke, it's more what you know, and you got to get yourself unbroke first.
Hmm.
But I don't know when exactly that paradigm is. Maybe around the first. I mean, certainly you need to have a $250,000 net worth.
Hmm.
If not, I think don't even waste your time talking to other people, because the quality of people you're interacting with are going to be all very low bottom feeders
Hmm.
that are just looking for themselves. This is that concept. If you never go to just a random networking meeting, because everybody's broke, looking for jobs, looking for
Yep.
money,
Yep.
right? Um, at some point there, maybe like 5, 6 years ago, I started to pay like 20, 30, 50 grand to join these mastermind groups. And some of these are, you can never tell, right? But it does make sense. Like the pay to play groups is, ups the level of caliber of people there. So at least you're
For sure.
fishing in a slightly better quality pond.
Hmm.
And if you have the platform built, right, you have your own business, and then now you're able to mix with other people in different verticals, then things get really, really cool. I mean, that's essentially what happened to me, right? Like I had 11 rentals in 2015. Then I started to mix it up with other accredited investors, and that's where I really started to hit hockey stick with my
Yeah.
assets under management from there.
Yeah. And now over 10,000 rental units. Are most of these in apartment buildings?
Yeah, we specialize. I mean, people do self-storage, mobile home parks in the real estate world. Um, for us, it's like multifamily workforce housing. But, I think for us, like the game has always been changing, right? Like we started with a bunch of Class C apartments because that's all we could afford at the time, then stepped
Mm-hmm.
up to nicer B class assets.
Okay.
Lately, there's a little bit of a nice little bubble with nicer assets because the lower ends are getting squeezed with a lot of new supply, the Class A coming online. I know I'm getting a little technical, but we started to develop too, right? And
Mm-hmm.
look, I'm a big fan of real estate. Real estate is what got me to the big dance here, but with interest rates going to be high and elevated for the next decade or so, you know, the we've been switching to investing in people's businesses as micro private equity,
Oh,
at
really?
least to add to our offerings.
Interesting. Okay.
Real estate, you need prices and the loan to be good in combination, right? Like
Yeah.
right now, prices are great. Prices have come down 20 to 30% off the peaks. It's been a bloodbath in commercial real estate.
Mm.
If you don't know and you're going to wait till Wall Street Journal writes about it in 6 months, you're behind on the times, dude.
Yeah.
You've already, I mean, I've already seen it kind of bounce off the bottom and prices starting to come back, but still the deals don't really work even at these prices, you know, because the interest rates are still relatively high. It's only come down 10, 20% off the peaks.
Yeah. And the banks are cracking down on that as well, right? Like they're less willing to give leverage to commercial real estate groups at this point. It seems like anyway.
Well, that's the way it manifests out in commercial real estate. Like the interest rates they seem to stay in the same band, like 5%, 6.5%. Whereas opposed to residential real estate, there's only one lever to move, which is the interest rate. That's why you see it going all the way up to like 8, 9%. But in commercial real estate, the interest rate stays the same, but the lever that moves is the LTV.
Mm.
So it used to be maybe a few years ago, you could easily get 70 to 80% leverage. Nowadays, it's like 50 to 65% leverage.
Wow.
And that's what kills the deal. You think it's not much, you got to bring 10% more to the table, but that's on a $50 million deal. That means you got to bring in millions of dollars. And that just
Right.
kills, you know, the returns at the end of the day is how much did you make divided by how much you invested, the denominator. If your
Mm-hmm.
denominator goes up by 10, 20%, you just killed your deal, right? You're not making
Right.
100% return anymore. You're making 70 something.
Right. Right. So now you guys are more shifted to acquiring businesses, companies.
Yeah, I mean, we still look at real estate deals. Like we just closed a deal late last year where it was an assumable loan.
Okay.
So the price was lower, right? It's today's prices, but it was an assumable loan that we got from 2020. So it's
So
like a 3.8%. So that's an anomaly though,
right. Right.
right?
Yeah, that's crazy, man. It's going to be really interesting to see what happens in that space over the next, I mean, really the next 12 months, 12 to 18 months. Cause I think a lot of people were taking these like 36-month short-term loans that are all going to be refinanced and just they're going to make the deals undoable. They're sitting at a 5.5 or 6, and then they're going to have to refi into something significantly higher than that. And it's going to destroy any sort of cash flow that they had, if there is any cash flow to be had. So it's really interesting to hear that somebody like you who has as much real estate as you do, even you're looking at that landscape and going like, we might be better as far as returns to our investors to start putting some of these into some private equity deals and see if we can negotiate, owning a percentage of this business that's cash flowing because we can get a better return there.
Yeah. I mean, it's just, I've always kind of made pivots. I mean, I see myself as a kind of a confident person somewhat, right, in my beliefs. But, at one time I thought single family homes was going to be my ticket to the big dance. And then I obviously changed my mind on that and did the
Yeah.
syndication stuff. And then, real estate is great, but I had, 80, 90% of my net worth in real estate the last market correction. And what did I get hurt? So I think in the future for me personally, I'd like to diversify into businesses um, more. And then, also angel investing too a little bit, right?
Is there a particular sector that you're looking into on the private equity side? And what are the core differences that you found between shopping a multifamily deal and owning a piece of a company?
I think the biggest thing for us is the people, the operator.
Hmm.
A lot of the people that we've done deals with, we've had previous relationships with, whether they were our investors or we were in different mastermind groups together.
Sure, sure.
Um, you don't find out people. I mean, it's people first, right? Like
Yeah,
I said, you don't know how people are until bullets start flying and people start losing money and things go wrong. But if you can start a relationship on the foot where you're both in the trenches together, working on your own thing, and see where they're coming from, as opposed to just meet at the apex of let's do a deal, right?
yeah,
Like that's kind of like, hey, you want to have a kid? You're a girl, you're a guy, you want to have a kid? Let's get married.
Right.
That's stupid, right? But that's how a lot of people do partnerships and deals,
Yep.
right?
Yep.
I think that's not to say that I'm right, but it's just where we're at today's. And if for people who say that they can't tell how people are, or they can tell who are good people, I think that's total BS, right?
Yeah.
Like, I mean, I don't think you can. You can try your best. You can get a little bit better odds, but you can never take apart like the counterparty risks in some of these deals sometime. But you try your best and you diversify at the
Yeah.
end of the day. And the nice thing too, like with these deals is like, I mean, people don't realize, even in REITs, right? Real estate deals, like how much the institutions take out of the deal from
Yeah.
fees and all this
Yeah.
extra BS. And if you can cut out all those middlemen and just work with straight with the people, invest directly in the deal or the real estate asset, you don't really need to have an operational genius. You just need to not have people that steal money or all gonna do fine because you don't have that institutional bloat
Right.
to feed.
So tell me about the wealth elevator. Why? I mean, you're a really busy dude, Lane, obviously. Why write the book? Why now?
I think like my passion was always like there were always guys like myself who were kind of stuck in the trenches, right? We were all misled to go to school, work hard, work a job, invest in the 401k, which is just Wall Street's institutional way of getting your money so that they can make a boatload of money on when you taking all the risk. I obviously drank the Kool-Aid when I started to invest in rentals, and I realized the man behind the curtain in Wizard of Oz reference there is not real, right? And that said, you're getting off the beaten path when you're investing in alternative investments. So my goal was to create the ecosystem and then this path of like how to ascend the different floors of the wealth elevator, right? Like most people are in debt. They need to keep a freaking budget. Go listen to Susie Orman, Dave Ramsey, right? There's a lot of guys that, you know, maybe they don't have get paid very good jobs. They read the Rich Dad Poor Dad, but there's no actionable advice there. My clientele are guys who make decent salaries, right? Or successful businesses, and they need to then accelerate to past the credit investor status and beyond, right?
Mhm.
That's our group.
Yeah, no, I love that, man. The wealth elevator. Is there a particular place you want people to go get that, or just?
Yeah, they can go on Amazon. I also do have a podcast, and if people are interested, they can go to thewealthelevator.com/master. We get a free 12 series masterclass there. People like to learn in the webinar format, but yeah, like I think at the end of the day, I know your guys' group are a lot of entrepreneurs. You know, with real estate or in passive investing, you need to have money first. Make no mistake, you gotta concentrate and take risks with your own business or venture first.
Yeah. Yeah, there's got to be delta. There's got to be delta that you can invest somewhere. So yeah, go pick up a copy of the Wealth Elevator from Lane. Go check out some of the stuff that he's working on. It will let you start understanding where you are currently, and then start seeing a clearer picture of where you want to go and actually how to get there. There's a lot of people in this space. I've talked to, I mean, who knows how many people who do this at this point. I wanted Lane on the show because he actually is seemingly one of the people that's out there doing legitimate work in the space, has a very good grasp on what he's doing. So do not sleep on these types of connections and opportunities. Please go pick up a copy of The Wealth Elevator, or if you like listening to the podcast, obviously you listen to this one. If you want to learn more about real estate and different things that they're talking about over there, then search for Lane's show in whatever podcast app you're listening to right now, and you'll be able to find it there. Lane, thanks so much for doing this, man. I appreciate you. Everybody else listening, tuning in. Remember, money only solves your money problems, but it is a little bit easier to solve the rest of the problems if you do have some money in the bank. So let's solve that problem first here on the Travis Makes Money podcast. Thanks for tuning in. We'll catch you next time. Lane, thanks so much for doing this, bro.